Welcome to The Explainer. Today, we're going to pull back the curtain on international trade finance. We're going to figure out exactly how a $500,000 import deal gets that big green light from the bank. You know, it can seem like this impossibly complicated puzzle, can it? But as you're about to see, when you really break it down, it all boils down to one simple thing: proving you're credible. And that's the magic number for the deal we're dissecting today. We are looking at a $500,000 letter of credit. That's basically a fancy way of saying it's a promise from a bank to pay the seller for the buyer, and in this case, it's for a big shipment of crude palm oil, coming all the way from Malaysia to India. Now, here's the thing that makes this case so interesting. The bank has pretty much already given this deal a big thumbs up. It's what they call a near certain approval. So our job today is to figure out why. What makes this deal such a slam dunk? All right, let's start with the most important piece of the puzzle: the company that's actually asking for the money. Their financial profile, well, that's the foundation this whole deal is built on. And wow, you can see right away why the bank feels so good about this. This importer is a real financial heavyweight. We're talking a net worth of about $3 million, and this is key: they've done this before. They already have one successful major import under their belt. This chart just says it all, doesn't it? The loan they're asking for is just a tiny fraction of what they're worth. I mean, their net worth is nearly 6 times the amount of the loan. From a bank's point of view, from a risk perspective, this is an absolute dream scenario. So having deep pockets is fantastic, but that's really only half the battle. For an international deal, you also have to navigate this maze of regulations, and that's where experience becomes a total game changer. For any import, there's a whole checklist of paperwork that's just non-negotiable. You need an import-export code, you need clearance from food safety authorities, that's the FSSAI in India, plus certificates from the country you're buying from. But here's the thing: this importer has done it all before. They've already jumped through all these hoops. Let's just take that food safety certificate, for example. You absolutely have to have it to bring edible oils into India. Now, if you're a first-timer, this could cause some serious delays. But for this company, it's just a simple, repeatable 3-step process they've already got down pat. And on top of everything else, they're just being smart about it. They're using a trade agreement between India and Malaysia called IMCEK. By showing the right paperwork, a certificate of origin, boom, they get to lower their import taxes. See? This isn't just about following the rules, it's about using them to your advantage. Okay, so the importer has a strong case, they're super prepared. Now, let's switch seats for a second. Let's look at this from the bank's perspective. What exactly are they seeing that makes them so ready to say yes? This is where it gets really compelling. The importer isn't just meeting the bank's minimums, they are blowing them out of the water. The bank requires the loan to be under 50% of turnover. This deal is sitting at 28%. They need net worth to be 1.5 times the loan. This company's is 6 times higher. It's not even a close call. And because the risk is so low, the bank gives them much better terms. They only require a 10% cash margin. That's the amount of their own money the importer has to put down. For a business that's less proven, that number could easily be 20, even 25%. So a 10% margin, that is a massive vote of confidence. In fact, the bank sees this company as such an ideal candidate. They might even offer an unsecured letter of credit. Think about that. That means they might not require any extra collateral at all, other than the goods being imported. In the world of finance, that's pretty much the ultimate sign of trust. So we have a strong importer and a happy bank. How does all this actually translate into getting the deal done? Let's look at the final numbers and the timeline. This breakdown shows you that the true cost is way more than just that $500,000 price tag. You've got other big expenses: the bank's commission, import duties and taxes, and even a fee for forex hedging, which is basically insurance in case the currency exchange rates go wild. The key, though, is that this company has planned for all of it. And here's the big payoff for all that prep work. Because the company is a known entity, because all the paperwork is perfect, the bank can issue that final letter of credit, the key that unlocks the whole deal, in as little as 3 to 5 business days. In the world of international trade, being able to move that fast is a massive competitive advantage. So, after breaking all this down, what's the big takeaway? What can we learn from this picture-perfect example of how to secure trade finance? At the end of the day, securing major financing isn't about some magic bullet. It's about building a complete picture of credibility. It's that powerful mix of financial strength, proven experience, being ready for all the regulations, and having a smart plan. Each one of those pieces makes the others stronger, creating a case that's just too good to deny. I mean, this was a textbook case of how to do everything right. It was clean, strong, straightforward. Which really makes you wonder, doesn't it? How do the newer businesses, the ones just starting out without that perfect financial history, how do they navigate these waters? Well, that's a very different challenge, and a story for another time.